Lorraine Suku with investmentpropertyfunding.com. We lend money to real estate investors to make profitable deals happen. Most investors have read a book or taken a course and learned how to calculate the after repair value of a property. But what I've discovered is that some investors are entirely too optimistic when calculating the ARV. Lenders have to play it safe because it is our money that is on the line. We have to lend based on today's reality, not on what might happen in the future if you do everything you say you're going to do, if there are no major mishaps, and if the market moves your way. I encourage you to calculate ARV like a lender. That will allow you to pass on those projects that don't have a large enough spread to be fundable and also provide a nice profit.
Okay, let's talk first about why the after repair value is important. Well, first of all, it's a good indicator about whether there's even enough profit in that property to consider it. Also, loans are sometimes calculated as a percentage of ARV. More recently, ARV has actually been a secondary consideration for lenders after the cost to complete the project, or in some cases, the as-is value. One of the trends now is for private lenders to lend a percentage of the cost of the project. Cost is usually defined as purchase plus rehab, as long as the loan doesn't exceed a percentage of the ARV. So, for example, they might lend 80% of the cost as long as that number isn't higher than 65% of the ARV. Well, that's a little confusing, so let's go over a sample. So assume that the purchase price is $70,000, the rehab is $30,000, and the after repair value is $150,000. So the costs here are $100,000, that's $70,000 plus $30,000. So lenders will often lend 80% of the costs. So that's $80,000. So if you take 65% of the ARV of $150,000, that is going to equal $97,500. So since $80,000 is lower than $97,500, most lenders would consider this a safe loan if the $30,000 for rehab was kept in an escrow fund. Now, if they're only lending 80% of cost, that means you, the borrower, need to come with the other $20,000 of costs, or you can get a gap loan from us. I've got a video on the website that talks about gap funding. But the $20,000 is going to come from you. And even though it's your own money, more and more lenders are requiring that you put that money in an escrow account to be used specifically for this project so that it doesn't end up being used for something different, and then you don't have the money to complete the project, and then the lender can't get his money out. Okay, back to our discussion of ARV. First of all, we're going to look at sold comps. Find 4 of them within a half-a-mile radius. The same subdivision is best. That's sold during the past 90 days. Now, I know a lot of people say 1-mile radius and 180 days, but lenders are conservative. So let's bring it in tighter and more recent. These comps should have 60 days on the market or less. So if you find 8 properties that have sold within 90 days, you want to choose those that have the lowest, well, actually, you want to choose those that are the most similar to your property, but after that, narrow down by the ones that sold quickly. Make sure you're comparing apples to apples, so they need to be as similar to your property with respect to architecture and square footage and year built and lot size or acreage, all of those things, number of bedrooms. Then you're going to look at the property photos of those sold properties to determine whether they were sold before they were rehabbed or after they were rehabbed. Still talking about sold comps. While you're doing this process, you'll be able to verify that your buy price is in line with, or preferably you want to be lower than, the other houses in that neighborhood that were sold prior to rehab. Especially take a look at the condition of the properties that sold with low days on market. and take note of what rehab you're going to need to do to move those quickly. Then, after you've found the best comps, calculate the average price per square foot of those sold properties, and then multiply that times the number of square feet in your property, and that will give you a tentative after repair value. So then we want to do the same thing with active comps, which are the properties that are currently on the market. Find at least 3 actives, again, as similar to your property as possible, and then calculate the average price per square foot of those actives and apply that to the square footage of your property to see what number you get. Again, make sure you're looking for actives that haven't been on the market for a year. I mean, you want to know what your current competition is, the ones that have been recently listed. This is the competition you'll have in selling your house, and you want to make yours better somehow or as good for less money to sell yours quickly. Okay, so you should have 2 numbers, a tentative ARV based on sold comps and a tentative ARV based on active comps. So you can figure out the average price per square foot with those 2 numbers, or lenders will often use the lowest number for the ARV calculation. Now here's a warning: if there are no really similar comps for your property, then it's going to be more difficult for you to find a loan. That's just a reality. I had a guy call me just this week. He has a house on the lake. It's one of the Great Lakes. I forget which one. But he's got a lakefront, beachfront property. And in that area, people don't sell their houses. So the most recent lake house that was sold was 3.5 years ago. We've talked to 3 different appraisers. None of them know what to do with it because it's too unique and there isn't anything recent. They don't know how to value it. So they want to charge him way more for an appraisal, and they want a month to complete the appraisal, which is crazy. So that's an example of a property that's going to be a problem getting appraised, and it will also be a problem getting a loan. Okay, after you've got your ARV, you can plan your rehab. You're going to want to identify what upgrades were made to those properties that sold fast for the highest dollar. At a minimum, you need to fix anything that would prevent somebody from being able to get a mortgage. But after that, it's kitchens and bathrooms, and then neutral paint and neutral flooring throughout the property. So you're going to need to get estimates from contractors. But before you do that, you should define the scope of work in writing with as much detail as possible. So if you've already decided what floor you want, you tell them, Home Depot, carpet number 1, 2, 3, 4, 5. You tell them what kitchen counter you want, what faucets, whatever. If you've already made these decisions of what you want in the house, and you can define the scope of work very specifically, then the contractors that come will have something in writing, and you know that they're bidding on the same thing. If you have nothing in writing and you're just going to walk through the property with each contractor one at a time, you may end up getting bids that don't really compare one to another because your ideas evolve over time and different contractors have different suggestions. But if it's in writing, you're more likely to be able to compare those estimates because they're more likely to be bidding on the same thing. You're going to need your estimates to have line item detail so that you know what each thing costs. That if you're getting a loan from a private lender, it needs to be that specific because that's how the payment is made to the contractors, what has already been done. I have another video that kind of goes over that. Make sure you don't over-improve. If you do, it comes directly out of your profit. It's hurting your bottom line. Next, I would like you to think of an appraisal as your friend. A lot of people are hoping that their own CMAs and comps and research will be good enough, and appraisal will not be needed because they don't want to pay the $400 or $450 for that. And I certainly understand it, but I just want you to know the lender can make a decision much more quickly if he's got an appraisal on hand. Lenders are more comfortable when there's a licensed appraiser who has established a value and supported that with data. Okay, well, I hope there was some helpful information for you in this video. You can download an application from our website at investmentpropertyfunding.com/apply. And my name is Lorraine Suku. I look forward to getting your application.